Thanks for staying with us here on Business Nigeria. Nigeria's external reserves have climbed to $49 billion, reinforcing confidence in the economy and strengthening the naira amid ongoing reforms in the foreign exchange market. The steady rise has been viewed by analysts as a sign that policy adjustments by President Bola Tinubu's administration are beginning to yield tangible results. Governor of the Central Bank of Nigeria, Yemi Cardoso, recently disclosed that Nigeria's foreign reserves rose from $46.7 billion to $49 billion in February, representing a 4.93% growth. He described the development as a significant turnaround from the position inherited at the Apex Bank. Let's look at this development and other burning economic issues. My guest is Tajuddin Ibrahim, who is the Director, Research and Strategy, Chapel Hill, Denham economic expert, say the stronger reserve position is already calming volatility in the foreign exchange market, reducing speculative pressures and improving investor sentiment. Director, Research and Strategy at Chapel Hill, Denham, Mr. Tajuddin Ibrahim, is joining me on Business Nigeria. It's good to see you. Let's start from the basics. When Nigerians hear that reserves have risen from $46.7 billion to $49 billion, it sounds positive, you think, but in simple terms, what does this increase really mean for the economy? Does it genuinely strengthen the naira and investor confidence, or is it more of a temporary cushion?
So it's generally speaking, is a positive development for the economy when you consider the fact that a much more buoyant FX reserves is indicative of, number one, a much stronger currency, for the exchange rate. Number two, and importantly, it is indicative of an improvement in foreign currency inflows into the economy. So when you look at it from the export standpoint, it is indicative of a lot more robust improvement. When you consider it also from a capital importation perspective, it is indicative of an increase in inflows. Interestingly, also, when you consider the import segment of the Nigerian economy, what you would see is a development that shows that our import is really slowing down while our export is rising. So eventually what you will most likely see on the trade leg of the economy is a situation where we have trade surplus, particularly considering that our import bill is slowing down in terms of the rate of increase, because we have what I describe as import substitution. And I say import substitution because it is largely speaking what we are experiencing in the oil and gas sector. When we talk about PMS production, for example, all of the value chain of PMS production is now localized. Localized in the sense that, number one, we extract the crude oil locally. Number two, we now are able to refine it locally. Number three, we now are able to consume PMS that is locally produced, locally. And then interestingly also, we export to other countries to generate FX, And one key element that I also like in the entire reform policy formation is that the crude oil is being sold to local refineries in naira, which is a policy that has not been considered in the past. So more like a new policy, which I believe is underpinning the performance of the naira. So what we have is a situation where our import substitution is enabling our FX reserves to be a lot more buoyant, in addition to a solid inflow of capital from overseas, particularly from a foreign direct investment standpoint, and more importantly, from a foreign portfolio investment inflow perspective, which is the largest element here, if you ask me.
Absolutely. So, Mr. Ibrahim, we saw the exchange rate unification policy last year. At first, it triggered volatility and sharp depreciation. Now, analysts say speculative pressure is easing. Would you say the foreign exchange reforms are finally, finally finding their footing?
Absolutely, I believe that those reforms are finding their footing largely because we have a situation where policy implementation by the current administration is largely being underpinned by the monetary policy of the central bank. In this case, I'm referring to all of those reforms that the Central Bank of Nigeria implemented in the foreign exchange market. All of those reforms, particularly from a trading platform standpoint, the Central Bank of Nigeria introduced what we call the B match. That B match has really helped in number one, the ability of participants or players in the FX market to be able to land what we call price discovery. It has also, number two, enabled market participants to be able to have a lot more transparency in the market compared to before the introduction of the B match, platform for trading. That is a one major, policy implementation by the central bank, which has been, broadly speaking, been supportive. Number two, it is interesting that interest rate in Nigeria is relatively more appealing compared to what is obtainable in advanced economy. And the attractiveness of the spread between the interest rate in Nigeria relative to the advanced economy is driving inflows of foreign portfolio investors into Nigeria, and that is also underpinning our FX reserves. And that, to my mind, is what we should watch out for. And the question would be, are we likely to see capital reversal anytime soon? I think no. Are we likely to see a lot more inflows in the coming months? I think yes. And the reason is that we have a situation where, externally speaking, in the US, for instance, the outlook is for a more depressed yield on investment securities. And when you have more depressed yield outlook, most of the portfolio managers in advanced economies will be looking for emerging markets where yields are a lot more attractive, and Nigeria has proven to be a major destination for them. So it looks like the stability is here to stay, and it is looking like all of the reforms and policy implementation are, broadly speaking, supportive, being well synchronized.
Absolutely.
Between the government and the monetary authority as well.
Yeah, that's right. Yeah, many Nigerians will be happy, listening to this information. Listening to these, analysis from you. But these $64,000 questions, many Nigerians might ask on another leg is that if reserves are stronger and reforms are working, as you've said, then why does everyday life still, feel harder? Is there a disconnect between macroeconomic stabilization and microeconomic reality?
I think there is no disconnect, right? Because what we see on the micro leg of the economy is largely a reflection of what is happening to the macro indicators. The reason I say it is not really disconnected is because whatever exchange rate is applicable in the market is what I would get as an individual. If I get onto the market as we speak, particularly the parallel market, I'll be buying the US dollar at a rate that is not more than like 1,400 naira to a dollar level. So that is indicative of a much lower rate compared to previously, like a year ago or thereabouts, when it was about 1,500, 1,600. So I think, we have to bear that in mind. That is number one. Number two, when we talk about economic reforms, and broadly speaking, we are looking at how it impacts Nigerians or the public generally speaking, I reckon that there is always a time lag in terms of how and very quickly, all of those macro indicators are reflected in the lives of everyone in the economy. So it is that period that I reckon we are in now. And my sense is that over time, we most likely are going to see, the impact being felt by nearly all Nigerians, as a whole,
Yeah,
because indeed that is when the public is able to appreciate all of the macro indicators.
absolutely.
Bear in mind, Rome was not built in a day, and
That's
I
right.
think there'll be a time lag, which I believe we have to bear in mind.
That's right. But then Rome is in existence, and everyone wants to, have the feeling of living in Rome. But then let's have a deeper reflection, on this. Can reserves alone sustainably defend the naira, or does long-term currency stability depend more on boosting exports, manufacturing, and maybe non-oil productivity?
I reckon the starting point is import substitution. And I believe that, we currently are seeing the benefits of having, an investor like Alhaji Aliko Dangote with the Dangote refinery. I believe that, all of the activities, we are seeing in that at that refinery is reflected in the pricing of the currency with 650,000 barrels per day capacity. And I reckon that, we can, over time, begin to, localize everything that we do when we talk about oil and gas, particularly when we talk about, PMS production. No doubt, we still import some volumes of PMS into the country. I believe over time, by the time more investors in that space build capacity, new refineries, we most likely are going to see a situation where we have we have more of the localization of PMS production, where mostly the oil marketers will be buying from local producers, which means our import bill with respect to PMS will come to zero. It currently is a couple of billion of dollars, but that number has to come to zero for sustainability. That is number one. Number two, we also need a situation where there's an increased investment in the oil and gas sector, particularly when we talk about new oil fields being discovered. We need the development of such fields to begin to produce and for us to be able to export out of the country and generate more FX. That, to my mind, most likely in the near term is going to materialize, because we have seen a couple of investments by, for example, Seplat, also, for example, Aradel, and we are seeing them in the nearest future having to invest to build, a lot more capacity for output. Let us take away from oil and gas and go to other, non-oil, sector. In that sector, we currently are not doing much as we speak. So my sense is that we must put in place, the government has to put in place policies that will incentivize, corporate, or let me say local investors to put in money investment in that space so that we can have more output, not just output, but output that we have added value to. And then we do some more exports, we will be earning more FX on that front. So when you combine a case where your export is rising on the one hand and your import is falling on the other hand, then you're already building a case for a sustainable stability of your exchange rate over the long term. I think these are the elements the government and investors should be looking at for long-term stability of the currency.
Right. So, Mr. Ibrahim, before I let you go, if we fast forward, 12 to 18 months, what key indicators should Nigerians watch to know whether this reform era has truly succeeded? Is it inflation, FDI numbers, job creation? what's the real scorecard?
So number one, we should have a situation where there is an improvement in what we call the ease of doing business. This, to my mind, is one of the major responsibilities of the government. That is number one. Number two, if we have a situation after the ease of doing business improves, you are going to see more Nigerians even be willing to do more businesses, to invest more in this economy. When you see local when you see local investors investing in the economy, you will be attracting foreign investors into the economy. And what they will be bringing to your economy in terms of inflows will be more of foreign direct investment, which is a more sustainable and long-lasting form of capital importation into the country. I believe that in the past we have been able to attract large corporates across the world, such as those that make beverages, such as those that make baby food, such as those that make baby diapers, and all of those elements. I really don't want to mention any company, but the reality is that we need to attract more of such giants into the economy. By the time we are able to do that, we are creating jobs, because when they come in and settle and build their businesses, there will be job opportunities for Nigerians. And from that, we'll be talking about a larger improvement in the savings pool for the country, because when you create job, what you are doing is that you are also creating an opportunity for savings in the economy. I mean, above all, I believe we should also work around improving the infrastructure architecture of the country. We should invest more from the government side and encourage more, private sector investment in infrastructure. When you do this, you will also be attracting and facilitating more local investment into in the economy, and also be attracting more foreign investors into your economy.
Yeah.
The chief marketing officer of Nigeria is our president, and we have seen him go around the world, pitching, to investors. We are going to see them come in when we put in the right policies that will make the ease of doing business top notch, for us in this country, and also a situation where we have more local investors, putting their money in the economy. Foreigners will also be encouraged to bring in their money. I think when we see all of these elements, Nigerians should begin to believe more that all of those reforms and policies are here to stay, to support and drive the growth
Absolutely.
of the broader economy.
Right. Director, Research and Strategy at Chapel Hill, Denham, Tajuddin Ibrahim, thank you so much for your keenness of insight. Thank you.